Good morning from London. I'm Anna Edwards alongside Guy Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Donald Trump says he'll start sending out unilateral tariff notifications today, with some levies as high as 70%. They'll come into effect on August the 1st. The president's signature $3.4 trillion tax bill passes Congress. He's set to sign it this afternoon. Plus, the Fed's Raphael Bostic urges patience on rate cuts despite US job growth exceeding expectations in June.
We're an hour away from the opening trade. It looks like we do have European equities in the red. Euro Stoxx 50 futures underperforming, down 0.5%. S&P futures giving back some of yesterday's gains. Remember, it is a U.S. holiday today. Euro dollar gaining again today. That dollar strength of yesterday did not last long. The countdown to the opening trade starts right now.
We're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs.
I hope you could hear that. There's quite a big range there in terms of the tariffs the president is proposing. 70%. Who's going to get 70%? That seems like a very high number. We've walked back a lot of the tariffs recently from high levels to low levels, but maybe, Anna, we're about to see them go back up. Basically, the tariff story is in the Post.
Yeah, that's very good. Yes, it is, absolutely. But who gets 70% is a very good question to ask. Who gets 10%? We don't know. There's a big wide range, as you say. So anything between 10 and 70% is what we might
do you sort of open the, you're kind of opening the letter? It's like exams being opened. Kind of, what did I get?
Yes. Yes, it feels that way. Feels that way. I'm getting.
Why not an email?
I'm getting some kind of
take a few days
stress reaction.
Yeah. But it doesn't take effect until the 1st of August.
That's right. We've got a new date to play with. So July 9th, that's still kind of on the radar. But now August 1st is when these things come into. So this raises so many questions. I mean, what do we do in between these letters going out and August 1st? Is there room for negotiation? So is that some kind of extension? If there is any room to talk, then that could be seen as a bit of an extension. But really, the markets are looking at this quite nervously. You see that in European and US futures. Over in Asia, really interesting. We're seeing a little bit of negativity, not on the CSI, because it seems some markets focus more on the fact we've seen the Chinese confirm that Geneva-London agenda, whatever you want to call it, between China and the United States. But 8 shares in Hong Kong, they were under a little bit of pressure earlier, and some saying this is because there's fear that we could get more of the Vietnam-style deals here, with transshipment being an issue and China limited in its ability to get stuff around the world.
How does the market react? Do we get... if the numbers are big, do we get a big market reaction? Or have we gone past that? I don't know. Is the market beyond kind of being concerned about this?
Yeah, in every individual geography, will we have market expectations that are either met or exceeded, or the number comes in lower than that, and that might dictate, I suppose. Like, for example, South Korea, a lot of weakness in the South Korean market this morning. Has Vietnam shifted their expectations?
But the last time we were out there with the big board and kind of we were dealing with numbers and things like that, we hope you can see me. The market tanked on the back of that. It doesn't feel like that's the setup going into
I just feel like the market has just stopped really trading off of these trade headlines. I don't know. I mean,
I feel that's a big bold statement, Valerie.
This August 1st extension. You know, the market is just assuming that these trade negotiations might take place during the entire Trump administration.
Yeah, but it's also a different question whether the Stoxx 600 moves and whether individual equity markets around the world move. You know, we saw that a bit with the Vietnam announcement, that something was good for the Stoxx 600 seen as negative in another part of the world.
The Vietnam announcement did surprise many, that they would be okay with the 20% number. So I don't think that bodes well for what could be in these letters, essentially.
Who's going to be okay with 70% is my question. Is somebody genuinely going to get a letter with 70% on it? You've got to assume that that's not going to go down well. We'll wait and we'll see.
Maybe if it's one of those islands where nobody lives.
Penguins.
In which case, no one will read it. But yeah, we'll wait and see, won't we?
Trump is going to have, maybe he's going to need the auto pen. I don't know. He's going to have a very sore hand. He's signing an awful lot of letters at the moment, and also the big, beautiful bill. That's going to come a little bit later. Call it the reverse Robin Hood. Maybe you could call it that. You could call it the buy now, pay later bill. I don't know. There's lots of things I'm seeing floating around at the moment. The deficit is definitely going to be going up. That does seem to be what the latest scores on the doors seem to indicate in terms of the numbers around this bill. But again, the market seems pretty comfortable with all of this. The bond market doesn't seem to be showing any kind of indication that it's concerned about what is happening here. The deficit story doesn't seem to be a worry anymore. The tax cuts seem to be being taken as a good idea. There is going to be an immigration implication of all of this, so I think you can take it back to the labour market. We'll talk about the payroll number in just a moment. But it does seem to be a big win for the president's agenda. I think you can probably leave it at that.
Big win for his agenda. Tariffs were his first economic agenda.
Yep.
This one was the big part of the second bit. But I think this does show, Trump's power to unite the Republican Party. He's got this bill on his desk on July 4th, like he asked. I mean, at the beginning of all this, people were laughing at him that he could get this done by the end of the summer. And here it is. He's kept to his self-imposed deadline of July 4th.
Apparently, some of the holdouts had to be convinced on the golf course. Golf is going to be a feature of this programme. It's Friday,
as it should be.
And Guy is here, and he's very keen on this theme to run through. But I'm really interested, just with tariffs, I'm really interested in what is priced in the markets already about this big, beautiful bill. Because for a long time, we were really worried. Bond markets were worried about long-end issuance. That seems to have faded as a dynamic. Maybe the market trading more about growth assumptions, and this might be a boost to growth. If that's the case, have stocks built this in? Have US stocks built in the positives? Have European energy names built in the negatives? There's still a few questions, I think, that maybe even today we don't find out the answers to, because a lot of people are away from their desks.
The one thing we do know that the bond market reacted to was the beat in non-farm payrolls yesterday. It wasn't just NFP that beat, though. It was a string of beats. You had jobless claims coming in less than expected. You also had ISM services beating on the headline number, and the unemployment rate, shockingly, falling to 4.1%. So this is showing a solid U.S. economy. Again, you have to start questioning, if tariffs haven't affected the U.S. economy up until June, are they ever going to have an effect? And is possibly this one big, beautiful bill, this government spending, just means that the U.S. economy is going to accelerate until year end?
I mean, it could take a long time for prices to change on tariffs. As we were having a conversation a week or so ago, being reminded that the cost you paid for your stock that you have now will not maybe doesn't include the tariffs, depending how, on the shelf life, but the replacement cost will include the tariffs. And so maybe it takes longer for these price shocks to come through, if they come through at all.
Definitely a lot of still questions about the tariff pass-through to consumers. Who eats it within the margins? Is it the exporters who are going to eat it? The importers are going to eat it? But look, it's not showing up in the data. We do have U.S. CPI in 2 weeks' time on the 15th of the month before the Fed meets in July. But this data yesterday has really thrown a bunch of cold water on a possible July Fed cut, even throwing cold water on September, Guy.
Absolutely. The market's definitely pushing out the possibility of the first rate hike until sort of much beyond July.
And the equity market still took that as a positive. Normally when we see pricing out of Fed cuts, it's something
the
that
equity
dents the
market
equity market.
just goes up regardless.
Goes up and it goes up, and we're at record highs for
But you talk about the acceleration.
The
Is it just a story of not slowing down as fast? Is the vector here still lower, i.e. the economy is slowing, it just doesn't do it at the same rate that it was before? Or is it that it actually, to your point, re-accelerates at this stage?
I think it still shows we're still pricing out all of this November dismal outlooks on the U.S. economy. We're still pricing out the fact that the worry that we could currently be in a recession in the U.S.
I know we have to move on, but interested that Goldman on today out with a note that points in the other direction, sticking with September, October, December cuts, and actually bringing down their guidance for where we get to at the end of the year on Treasury yields, because they see more of these rate cuts coming. So something changes a lot then between now and September.
We've got some great guests lined up to talk about all of this, even though it is the 4th of July. We are going to go to the south of France, to the Luberon. Aix-en-Provence is the big economic event of the weekend. Ludovic Subran, Allianz's CIO, is going to be joining us. Bruce Andrews is going to be joining us from there as well. He's the former US Deputy Secretary of Commerce. We're going to be joined on set here in London, a little less warm. Ali Renison, SEC Newgate's Associate Director, here to talk about trade. Remy Olopitan, Schroders Multi-Asset Growth Head, is going to be joining us a little later, as will be Sri Kojagodan, Aberdeen's Senior Research economist.
Lots to talk about with them then. Some fascinating conversations still ahead. Also still ahead, this time of day we normally tell you what's ahead for markets, the data points we're watching, the key speeches. We have a few of those. Well, really, actually, we have the absence of an event today. We have US markets closed. That's the thing you need to be aware of course, because it is July 4th. Congratulations if you're celebrating wherever you are. Saturday and Sunday, we've got a couple of events in that we will be watching. We'll certainly get some analysis of what to expect from that OPEC meeting. That's on Sunday, along with the BRICS Summit. Bank of England, Andrew Bailey speaking as well over the weekend.
What else do you need to know this Friday morning? India's market regulator is temporarily barring Jane Street from its local securities market. The SEBI also plans to seize $570 million of what it calls, quote, unlawful gains from the US trading firm. The move comes after an investigation into derivatives trades. Jane Street says it disputes the finding of the interim order. Israel is intensifying military operations in one of the last Hamas strongholds in Gaza. This as both sides prepare for ceasefire negotiations that have been proposed by President Trump. The Israeli army has ordered tens of thousands of people to leave the outskirts of Gaza City and has stepped up airstrikes. The Israeli Prime Minister Benjamin Netanyahu is set to visit the White House Monday. And Russia has launched a massive drone attack on Ukraine's capital city, Kyiv, after a call between President Trump and the Russian President Vladimir Putin. Trump expressed his frustration at the lack of progress being made in ending Moscow's war on Ukraine.
I'm speaking to President Zelensky tomorrow, early in the morning, and I'm very disappointed with the conversation I had today with President Putin, because I don't think he's there. I don't think he's there. And I'm very disappointed. Well, it's not, I'm just saying, I don't think he's looking to stop. And that's okay. This is Biden. This isn't me. This is Biden's war.
President Trump and President Putin have now spoken a few times, haven't they? And they talked about not just Ukraine, they talked about Iran here, but on the subject of Ukraine, that peace deal that he so wanted, that he talked so much about at on the campaign trail, still remains elusive.
Yep. And we were reporting that Trump does have a call with Ukraine's Zelensky at some point today. So essentially, you know,
see if that moves
stalemate here, but
see if it moves the dial.
But it'll be interesting to see whether or not there is a restart of some of the weapons shipments that the US has been restricting recently because of concerns about its own stockpiles. It's maybe not sending the weapons over to Ukraine. Does that get resolved in the near term?
Yeah, coming up on the programme, we talked about the OPEC meeting that's taking place over the weekend. OPEC talks August production hikes this weekend. We will preview what's in store with the oil-producing alliance, plus how far is Donald Trump impacting Scotland's national pastime, that is golf. We will be talking about golf, certainly towards the end of the programme. Guys, very excited. Up next, we're in Aix-en-Provence. We're all very excited about this one, where Allianz's CEO will be joining us. Really good to get the views of Ludovic Subran. Plenty to talk to the CIO about when he joins us next. This is Bloomberg.
I believe a period characterized by such widespread uncertainty is no time for significant shifts in monetary policy. That is especially the case against the backdrop of a still resilient U.S. macroeconomy, which offers space for patience. And that's why I fully support the committee's wait-and-see policy prescription at our latest meeting.
Atlanta Fed President Raphael Bostic speaking there, reacting to the strength of the data, a better-than-expected US jobs report, of course, easing pressure on the Fed to cut rates, perhaps. Let's get further thoughts from Valerie Tytel this morning. And Valerie, it's interesting, you know, I read various comment pieces, some very much focused on the strength of the data, some very much focused on the fact that participation changed and there were a lot of public sector jobs created.
Oh, but look, Anna, it was a strong print across the board. You got to give it to the U.S. labor market, showing resilience yet again. A beat when it comes to non-farm payrolls and the unemployment rate unexpectedly dropping to 4.1%. It's also a beat when it came to the weekly jobless claims figures, which came out around the same time, and ISM services coming in stronger than expected. This is giving an echo of U.S. economic resilience in the face of tariffs. And to that, guys, we have almost completely priced out the chance of a Fed cut when it comes to the July meeting. Those two-year yields rising some 10 basis points over the course of that morning's session. I thought it was very interesting. If you take a look at the price action of the U.S. dollar, the Bloomberg Dollar Spot Index tried to rally on these short-term interest rates rising, but it was not successful. We actually ended the session close to being in the red, and over the 2 days, we're now back to flat. So again, the U.S. dollar, really, the momentum is to the downside, having a hard time rallying even on a print like that. We did see a rally when it came to the U.S. equity market. We both had the S&P 500 and the NASDAQ ending yesterday's session at record high. And Guy, have you noticed that U.S. equities have decently outperformed Europe in the last 2 months?
Yeah, we can currency adjust and we can have some fun since the beginning of the year. Sit down, we'll talk about this and figure out what is happening. Valerie and I will certainly be debating this. Currency adjustment maybe is a factor that we need to bear in mind. I don't know. Aix-en-Provence is the place where you want to be this weekend if you have an interest in global economics. And there we find Ludovic Sabra, the CIO and chief economist at Allianz. Ludovic, good morning. The US economy seems to be in great shape.
Good morning.
The US equity markets are at fresh record highs. What's the problem? Where's the uncertainty? Where's the downbeat mood that initially came from the tariff story and what was happening in terms of deficits? Where's all that gone? Equities in the United States are at fresh record highs. Is the market right?
That's a good question. I think we have to wait a little bit before people get very worried about inflation. As you know, the stocks that companies have been piling up are now being destocked. So I think for now, the equity market is just reflecting the fact that companies are full of cash still. They are not investing as much, but they are still in very good shape. For the bond market, I think it's signaling a bit of the orange light, right? It's such as the dollar. You just mentioned the story about the dollar. It's quite impressive to see the depreciation of the dollar. It looks like it's not stoppable. So I think there is this dislocation in the market, which is interesting, but overall, never bet against the American consumer, right? That's the mantra that we've been seeing over the past few days. It looks like the American consumer will continue to consume. The job market is still very strong, in spite of the stagflation risk piling up on the horizon. That's quite incredible resilience for the U.S. economy.
So I put money to work in the United States. Is that the right trade? Because people in Europe, elsewhere around the world, have been reticent to do so over the last few months.
Yeah, I think I'm still very worried about the overvaluation of the U.S. equity market. But if you look at the micro data, most of the corporates have already adjusted a lot their earnings outlook for this year. We're going to see more numbers in the coming weeks. So we're going to see at least those sectors, I mean, pharma, retail, that could be a bit in jeopardy because of the situation in the U.S. But it's true, it's quite impressive to see how much the market is pricing in the pragmatism of President Trump. And in the end, that a lot of the uncertainty that was really peaking in April and in May is now fading away. I still find it a bit of a difficult trade, mostly because I think uncertainty is still there and there are still more radical policies to come. But it's true that it looks like the worst is behind us, which is quite indeed impressive.
Yeah, indeed. So the market seemed to focus, as you say, on that pragmatism and perhaps some of the elements of his policy agenda that would boost growth, Ludovic, rather than worrying about some of the some areas that they might not like. Can I ask you about the impact of the One Beautiful Bill, whatever its name is these days? Because we've focused a lot on the politics, and I wonder underneath it what we need to understand about what this does to the US economy or where it moves the needle in the US at all for you as an international investor.
Well, I mean, for me, it moves the needle into a difficult territory for U.S. fiscal deficit. So we have expectation of the deficit reaching 7% this year and then 8% next year. Again, we still think inflation will going to be around 4% by the fall. So as an investor, there are more and more reasons to ask for 5% for the 10-year U.S. So I'm a bit of a bond vigilante right now, if you ask me, because of the friction risk from trade and the inflation risk from profligate fiscal. I think it's still a very good trade, but you need to ask for a bit more premium right now.
Where are the other bond vigilantes, Ludovic? Do you expect them to come out in the aftermath of President Trump signing this bill?
It's interesting because, of course, for us Europeans, the biggest part of the bill that was at stake was Section 899. Now, I think in the bill, of course, everybody's looking at what's happening with corporate taxation. I still think, you know, there are a lot of concerns about how the big, beautiful bill is, how the fiscal equation is going to work. All the Medicaid, Medicare talk is, of course, very important, and also what's going to happen on the receipts, on the trade receipts. So I think there's still a lot of discussions that are to come about the, I would say, the reliability of the big, beautiful bill. And so that could create, especially towards the end of the year, a bit of concern on the U.S. fiscal path. On Europe, I guess, you know, as you know, we also look at France in particular, which is one country which has a bit of concern on the fiscal space. But more importantly, we are looking at how we're going to finance our big war efforts. So fiscal is going to be very present for all of us in the second half of the year.
Ludovic, you mentioned inflation risks from the increased government spending in the One Big Beautiful Bill, but how are you viewing the tariff pass-through to U.S. CPI at the moment? There's a lot of speculation saying it's not shown up yet. Is it ever going to show up? We do have the CPI print on the 15th of the month.
Well, actually, for us, the main issue is really this stocking, destocking. We have a lot of data through one of our subsidiaries, Allianz Trade, about the delays of inventories. So the fact that a lot of U.S. corporates have been piling up very fast ahead of the tariffs and then have been destocking very fast. And so for us, that means that now the next wave of imports is going to be affected by the higher tariffs, right? And so that would mean that with delay, we could see a bit more inflation towards the third quarter of the year. But again, not a lot. Why? Because the companies have been passing through much less than they've been doing in the past years or the past pass-through of imported inflation. So right now in the CPI print, we see barely 0.1, 0.2 percentage point that have been passed through. And what they tell us, and this is a lot of the surveys that are being conducted, is that they will pass on less than 30% of the price increase, which is normally, you know, it's 2/3, 1/3, but the other way. So it looks like a lot of the companies don't want to kill completely the consumer because of the purchasing power effect. And so that would mean that there would be not so much of a positive as in negative surprise for inflation in Q3. So that's why we have 3.8% reading inflation in September. Still, at 3.8%, if you're the chairman of the Fed, you cannot cut. And so that's the main issue towards the end of the year. Can the Fed cut even once? That's one big question for us to understand the rate differential and the US euro-dollar path in the next 12 months.
Ludovic, if you do think that the tariff pass-through might be less than expected, you just mentioned there, 30% of the cost might be passed on to the consumer. Would that hit the company's bottom line more? Are we going to see a margin compression in the third quarter?
It depends on the sector. We've seen already a margin compression in a couple of sectors, especially industrial sectors, also because the subsidies on the IRA have been vanishing, but also because their inputs are particularly affected because they are importing from China. So I think we're going to see some margin compression in the tune of 0.5 point, which is still very low compared to the level of friction. So there is this realization also that a lot of these frictions is not completely passing through one-to-one, but more, half of it or maybe a third of it. And so that means margin compression will still be very palatable because remember, U.S. corporate margins has been rocket high for quite some years now. Since 2021, we've seen margin very high in the U.S. And so even in 22 and in 24, which were a bit of bad years, we've seen the margin still, 2 to 3 percentage points higher than the average of the past 15 years. And so even with 0.5 point of indenting, for the margin, it's still very comfortable margins. And so that's why I don't think this earnings season is going to be very bad, if you ask me.
Ludovic, I'm trying to kind of work it all out, put it all together, what you think right now. Let's talk about this through the lens of volatility. Is the second half of the year going to be less volatile than the first half of the year? Is that the environment we're going to be in? Because that feels like a more risk-on kind of world.
Very interestingly, I think this is what markets are pricing in. I still think, having looked again at the past 6 months, that this is a very uncertain bet. Because as you've seen, policy volatility is stemming from one person. And, there is still a lot to do and a lot of negative surprises coming in. Again, even if it's not as much, but if you account for margin and inflation and a little bit of questioning about where the public money is going and some of the ideas or policies that have been enacted and not being very efficient, I expect that the White House will also try to push through in a less linear way. So this idea that peak volatility is behind, which is what markets are pricing in, is a very, I would say, very critical pledge over the future.
Thank you very much. Thanks for joining us. Ludovic Subran, the CIO and Chief Economist at Allianz. Stay tuned. Lots more to come from the economic conference in Aix-en-Provence. Plenty of guests coming through from France. We will talk about Trump's tariff agenda next. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes until we get that opening trade for Friday, the 4th of July, here in Europe at least. No trading later in the United States, of course. Happy Independence Day, if you are that way inclined. This is the picture on futures.
You mean American?
Well, you know, others may pile in. This is the futures picture for European stocks right now. A little bit of weakness anticipated at the start of trade. More than a little, in fact, if you're looking at the CAC Cameron. And I wonder if this is to do with these tariff comments we've had from President Trump overnight, talking about how he's unilaterally going to send out these tariff letters. We'll get into that conversation in a moment. But, Val, this is what we have on European equity market futures. A little bit of nervousness being signalled here. And actually the Asian session just deteriorating a little bit, down 0.3% right now.
Yeah, let's take a look at the European fixed income open. We are seeing German yields headed lower, 2 basis point rally in the 10-year sector, really diverging from treasuries of yesterday. Yesterday we had quite a decent sell-off when it came to the treasury market. It did seem like German bonds were quite decently in the face of that.
Was yesterday a real session, though? It was an early close, wasn't it? It didn't have much time to digest the data. Maybe somebody was suggesting to me earlier, maybe a Monday session gives you a better steer.
Well, we are seeing Treasury futures rally at the moment, so they are rebounding a bit.
OK. There's going to be a lot to think about when it gets to Monday, because maybe some letters will arrive on doorsteps that will tell us what the tariff picture is going to be looking like. President Trump says his administration will start sending out those letters, setting unilateral tariff rates. A little later on today, more will apparently follow over the coming days. This comes just 5 days before, of course, Washington's July 9th deadline for negotiations, with many trading partners still struggling to finalise deals. We're joined now by Bloomberg's trade czar, Brendan Murray, on set. Morning.
Morning.
So the president's talking, he's just going to send letters out now. I think 10 to 12 are going to go out today. He was speculating it's somewhere between 20 and 70%. I wonder who's going to get the 70%. That number sounds extraordinarily high, unless you're a penguin. So how is the process going to unfold over the next few days? Because it does seem as if we are not going to get deals, and the US is basically just going to say, job done. So how's it going to work? Are we going to see extensions? Or are we just going to see some people just ending up with the tariff numbers the president dictates?
Yeah, well, first of all, it's pretty common in trade deals for things to come down to the wire. So even just one trade deal, can come down to the very final day, very final hours. And we're looking at, a couple dozen of trade deals that the administration is trying to pull together. So, and if you look at Donald Trump over the past 90 days, when things start to get bogged down, he throws out a threat and says, that's it, I'm getting tired of this, I'm gonna send out your letters. So I think what we're seeing is a bit of a negotiating tactic here at the very end. There very well may be some letters that go out, but what he's trying to do is unstick some of those conversations that are getting bogged down here toward the end.
Brendan, we also had news that China was set to cancel part of the EU summit that's happening in China later this month. Do you think that maybe China's getting a whiff of something about isolating China within the U.S.-EU trade deal, something like what Vietnam had with the U.S. about transshipments? Absolutely.
The part of the deal that Trump announced on Thursday with Vietnam was to have a tariff that was double the rate on goods that are transshipped. The message there is those are Chinese imports into Vietnam that are being turned around and sent to the U.S. So that China took as an attack on them, and they said that they would retaliate if that's what they determined this was. So I think what you're seeing between Brussels and Beijing is the two sides kind of jockeying for the leadership in the area of global trade. Now that Donald Trump is saying, we're America first, and we're going to kind of go it alone, and we want domestic manufacturing to come home.
Brendan, thank you very much. Bloomberg's Brendan Murray setting up the latest news flow for us for our next conversation. Let's bring in another voice. Ali Renison, Director at SEC Newgate, former advisor to the UK Business and Trade Secretary, and somebody we turn to on matters of trade fairly often. And thank you very much, Ali, for coming to talk to us. So not unusual for things to go down to the wire. This could be all part of a negotiating tactic from President Trump, talking about sending out these unilateral letters. We now have an August 1st date to put in our calendars, a new date to add to all the others we're watching. What's the big picture for you here, Ali? How would you think this develops?
I think the big question is actually Trump is not necessarily going to chicken out. I think there was a question about whether he's going to send the letters. There have been some countries that have been asking for deals, South Africa among them, and there's a big question about whether he does what he did with China, which is he puts the tariffs on, or he puts, let's say, export controls on chips, and then he changes his mind a couple of weeks later, a couple of days later, basically giving some more space for negotiation. So I think overall what we're seeing is basically a little bit of game playing at the end, but also keep in mind that there's quite a bit of pressure at home on Donald Trump to deliver deals.
We don't think China is part of this, though, directly, do we? I mean, China's interest here is, as Val was saying, maybe these transnational shipment rates that we saw as part of the Vietnam deal. But China has its own time frame. They've got this Geneva, London, where else did they agree? But they spent at least 3 meetings getting to this sort of truce on trade. And then they have another date in August, don't they, to reach something broader. But are you suggesting we could see something on China earlier than that?
Potentially. I think what you're seeing is China's really unhappy also. It has its own bilateral kind of relations between the U.S. and Beijing to worry about, but it's really unhappy about the amount of pressure that Washington is basically putting on third country trade negotiations that's going to affect China. So it's starting to try and flex its muscle there and saying it will take retaliatory action if it deems that some of these measures that are being put in place, let's say with Vietnam, that are affecting its trade across the sort of Asian region, they're going to retaliate if they think that that's unfair.
Ali, what's your assessment of the state of things between the European Union and the United States?
That's a $1 million question, because that doesn't just affect the US and the EU, it affects the rest of the world, affects our trade as well, because obviously the UK is bound up in UK and European sort of supply chains. I get a sense that Trump, as he threw out that kind of threat about he's going to go up to 50%. That's not even where they were looking at when we had Liberation Day, obviously. I think we're starting to get there. The big question that I think that Brussels is facing is it's not necessarily bringing all of its member states on board as quickly as it would like, and that is the big problem with the EU, is it's negotiating among itself in addition to trying to negotiate with Washington, and that part is not speeding up fast enough to try and get that deal with the US.
Does this look better for Europe? Sorry, Guy, just interrupted. On this subject, does this look better for Europe if they get to a deal, however imperfect it might be, before July 9th? Does that look better than receiving a letter from President Trump telling Europe what it will pay?
Absolutely. I think that, in terms of like the market signals that something as big as a deal between the US and the EU, or a lack thereof, that's going to be most important. And that's going to reverberate on the markets in the UK, not just in Europe as well.
Should we do, are these deadlines hard and fast? Is there going to be an extension? How do you think it's going to play out over the next few days?
We've heard Trump say he's not going to do an extension. We've heard the Treasury Secretary, Scott Bessent, say, well, actually, we'll leave it up to the president. I think we could be in the world where, some deals don't get done, you'll have the tariff applied, and then they might be rescinded a couple of days later.
What about Europe? How do you think, this is the big one. What do they do? Do they just say, we'll carry on talking? How long could that process last?
Well, keep in mind,
how much patience is there?
Keep in mind that actually the EU has also drawn up its retaliatory measures. It paused them. And the question is if it doesn't get in time, are they going to launch them? Or are they going to sort of carry on sort of talking? I think they'll carry on talking.
Would they only launch them if the US... I'm assuming they're only going to launch them if the US imposes its tariffs.
I think it depends on how they feel that the talks are going. If they feel that it's just a question of a couple of days, a couple of weeks, they'll hold off. But they have these things lined up, ready to go. That, of course, was
because 10% is still being applied, isn't it?
10% is still being applied as a baseline. 20% was what the EU was sort of going to get if it didn't sort of get a deal. But then the 50% thing that President Trump thrown out a couple of weeks ago, that's the big question about. That would actually definitely draw EU retaliation.
Ali, how much is the EU listening to corporates and what they want out of these negotiations? Bloomberg learned that European companies, including Mercedes and LVMH, are pushing for a quick trade deal in order to help their interests. Is the EU listening to corporations?
I think the EU is picking and choosing what it wants to listen to. So, for example, it's definitely listening to corporates about, please don't retaliate. We don't need to sort of compound the pain. But in terms of the things that it wants to, certainly, let's say the U.S. wants to move on things like food safety production rules. We know that Washington doesn't like that. Are they going to actually completely change their rules on that? Are they going to get rid of, digital services taxes? I think that they're willing to make some compromises, but not on some really fundamental pieces.
And what's your read on, the main sticking point between the U.S. and Japan is these auto tariffs, which I feel does have a read across into Europe with the, Germany's manufacturing hub being exposed to things like car tariffs. What's your read on the Japan situation?
Well, actually, you heard President Trump talking about rice in the last 24 hours. So, yes, there's kind of he wants Japan, as he sees it, to sort of take more cars from the U.S. Now, that's a little bit of a consumer pattern of behavior. It's a little bit difficult to get tariffs to move that. But, yes, on the kind of the auto tariffs, he wants that to kind of be lifted. But he also wants Japan to start taking more agricultural produce, including from the U.S. Apparently, we make rice back home. Who knew? But so I think it's a bit of a mix of manufacturing and agricultural sort of, and you're seeing that with India as well. So basically, what Washington wants India to do is basically open up to genetically modified sort of manufactured food. India has resisted that for a long time, but they have signaled that they're willing to sort of play ball on some of this.
Rice was a big sticking point, I remember, in the UK-India deal as well, but somehow that was overcome. More to do with processing, I think. So interesting you said about retaliation, that companies seem to be calling on Europe not to retaliate, even though you might think some companies might want some kind of levelling of a playing field from a European perspective. So do you think if we see retaliation, is that entirely political? There's no economic motivation for that?
Well, keep in mind that also one of the things that Brussels says is that it has this what's called the anti-coercion instrument, which basically allows retaliation on services, procurement for sort of access to U.S. companies to the European market. And Brussels' justification for looking at this retaliation is we got to spread the pain. We can't just have our goods sort of manufacturers being hit by retaliation. But generally speaking, I think what you're seeing is a lot of companies and corporates know, A, that the way in which President Trump sort of operates, if they retaliate, the scale of the U.S. retaliation could be considerably of a much higher magnitude. So they don't want to see this absolutely.
You end up like China.
Yeah, they don't want this to go layer upon layer upon layer within sort of. They know how quickly that could escalate. So they're pleading with the EU, and I think actually a lot of countries haven't retaliated. There's been threats of retaliation. The only country that's retaliated has been China, and we saw where that ended up.
Yeah.
We watch the stock markets every day. We're obsessed with it. And we're trying to work out why there doesn't seem to be an effect of all of this. The tariff narrative, we were expecting there to be huge kind of global ructions in the trade system. Yet that doesn't seem to be happening in the way that we all anticipated. Can you just, when does this start to have an effect? When do you think this starts to manifest itself? When does this become real in terms of global trade and having an impact in the data and showing up in GDP and CPI and all the other numbers?
I think when Trump stops changing his mind on tariffs. I think when we see a sustained period of time where a considerable tariff is applied and there's no moving away from that, and the market thinks, oh my gosh, these are here to stay.
Point?
Well, Trump is the deal maker, right? He has this he has these competing objectives. He wants lots of tariff revenue, but he wants to be a deal maker. And I don't think we're actually going to get to a point where there's not negotiations happening constantly. Keep in mind, though, if you look at the sort of retail and textile sector, it rose significantly because of the deal on Vietnam. Then they saw the details and it went back down. So we're going to see a lot of kind of up and down, but I don't think we're going to see a sustained kind of calm in terms of trade and tariff negotiations for some years, frankly.
Some years.
Years.
Mm-hmm.
Okay. Well, give us
we'll
something
see you again soon.
We'll see you. I was about to say, get comfortable. We'll see you again soon.
Book you in.
Ali, great to see you. Thanks very much indeed for stopping by to see us. Ali Redison, Director of SEC Newgate and former advisor to the UK Business and Trade Secretary. Coming up, we're going to talk about some of the corporate stories we are watching. Air France-KLM looking to boost its stake in SAS, the Scandinavian airline, to more than 60%. Your stocks to watch are next. This is Bloomberg.
The price of the dollar has nothing to do with a strong dollar policy. Strong dollar policy means several things. One is what is the dollar strong against, or is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are.
U.S. Treasury Secretary, Fed Chair in waiting, I don't know, could be, maybe, Scott Bessent there, dismissing the idea that the dollar's recent declines raise concerns about the status, its status as the world's key currency. I've never actually had the strong dollar policy defined. So it's nice to hear.
It's really good to get it, isn't it?
What the future Fed chair thinks about it.
I think it's really interesting that it's not about the strength in the moment. It's about putting in place the policies that maybe sustain its role in the global economy. So then you could launch into a conversation about whether the policies currently being enacted do that. So maybe that is the conversation we need to move on to, rather than whether the strong dollar policy then exists or not.
And look, in big picture, the trade-weighted dollar, I mean, since we went off the gold standard, is still very strong. I mean, yes, we've declined this year, but still, on a relative basis, the U.S. dollar is quite strong.
The question is, do they want a strong dollar? If we're talking about in absolute terms, you do wonder whether all this noise that's going on over here, trade policy, other things going on, whether actually the way that you shift the nature of the U.S. economy is by letting the dollar slide a bit.
Yeah, you can put a tariff on your trading partners. You can also allow your currency or not worry too much if your currency slips.
Yeah, or get mad at other countries who are weakening their own currency in order to, you know.
So we talked yesterday, you look at what's happening in the Vietnamese dong. It's one of the few currencies around the world this year that has depreciated against the US dollar. That's a nice way of leaning in.
Didn't get them a nice trade deal, though.
Didn't get, well, precisely, you could argue the opposite. It should have got them a worse trade deal. But I just wonder if there is a sleight of hand happening here. I listened to Bessent talking about this, and he's kind of, don't look over there, don't look at the level, look at the long-term policy. Don't worry about it. Don't worry about the level of the dollar. I find it, this is just a personal theory, all the noise about tariffs and stuff like that that's going on, which is capturing every headline around the world. The big story is actually you depreciate the dollar, you make the US more competitive, you change the terms of trade. It's one of the most straightforward ways.
It's an easier way than tariffs, frankly.
It's a much easier way.
But you got to put pressure on the Fed to keep rates low, so it kind of all ties together.
Yeah, it fits neatly together. So I don't know. It's going to be interesting to watch whether or not this depreciation continues. And in some ways, you could argue the inflation data will be something that shows that as well. But actually, the US economy is largely doesn't actually import a great deal of stuff. So I don't know. I find it fascinating that it's a story that kind of is just bubbling along day by day by day by day, and yet we're driven by the volatility of all the other stuff. Anyway, let's talk to Paul Dobson, Executive Editor for Asia Markets. Paul, nice to have you on the programme this morning. The trade headlines overnight have caused that kind of volatility, haven't they? They've caused some concern in Asia about the levels that we are ultimately going to see on the trade front. It was a reasonably sizable reaction, but not a big reaction. Are we getting immune to the trade headlines? Is that maybe what the takeaway from today should be? Yes, we're worried about it, but we're not as worried as we were on Liberation Day. We're not getting the kind of volatility as we did then.
No, not a panic anymore. And you're right. We're a little bit desensitized to it since we've heard so much and since we've seen so many times that escalation and then retraction or moderation that has pulled things back into a more reasonable range that the market might accept. And so, all of the price fluctuations that stung people on the way down and the way back up again, people are trying to look through that a little bit more. That said, so we heard from Trump in our morning, so right at the end of the US day, saying we're going to start sending letters out tomorrow, 10 or 12, telling people what their tariffs are going to look like. And that gives the market some cause for concern. Like, we don't know which countries are going to get it. We don't know what information we're going to get. We don't know how sizable they're going to be either. There's a long weekend coming up. Probably people want to take a little bit of risk off the table as a result of that. I think it's interesting, right? Probably the countries that are going to get these letters are ones that the US hasn't had time to talk to, so less significant ones. But nonetheless, it will be very interesting to see the details that we get within that to tell us what sort of approach overall the US is minded to take here.
Paul, he did float tariffs could range in the value from 60 to 70%. And on April 2nd, the countries that did have, numbers close to 50% were Southeast Asian economies. Is there any jitters in these Asian markets overnight?
I wouldn't say specifically people are more or less worried about that right now. But I think, it's partly because it could be smaller markets like Bangladesh or something like that kind of is a little bit under the radar of global investors, at least, that haven't had a chance to represent themselves to the Trump administration because of the fact that there's just so many of these deals to get through, right? So what we did have is Vietnam, at least, and so people can take a little bit of comfort from that, a little bit of a benchmarking from that. It wasn't as high as the US had initially started out talking about, even though it was higher than the tariffs had been previously. And so I think the markets took that with a relative degree of comfort and ease. There's scope for negative surprises. Maybe there's scope for a little bit of an upward surprise too.
Yeah, Paul, I think it's really interesting that a lot of our conversations about tariffs increasingly feature reflections on how uncertainty has a cost, and even tariffs that are high by historic standards might be better than constantly revisiting the subject. Let me move on to how the market has been responding to strength in the data out of the United States. What did you make of the way that the market just seemed to be quite impressed, really, by the jobs data?
Quite impressed by, And in terms of the stock market and in terms of bond market, that's July right off the table. The Fed can take the summer holiday off, come back, in the autumn, basically. And I think that is surprising because we had thought that maybe if the data were bad, that would be kind of like pushing for a Fed cut and supportive. Nonetheless, the market liked the good economic news for now.
The market did. Thank you very much, Bloomberg Executive Editor for Asia Markets, Paul Dobson. You can get further analysis from the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal 24 hours a day. Now let's get to your stocks to watch. Joe Easton has a host of corporate stories to take us through. Joe, good morning.
Morning, Anna. So starting with Rheinmetall, the company last night held a pre-close call with analysts. So this is kind of a briefing ahead of a blackout period before their earnings. And this is the takeout from JP Morgan this morning, writing that consensus on Rheinmetall is too low in terms of the free cash. They also expect to see a decent share price rise if orders come through as expected. They predict around 70 billion euros worth of orders at Rheinmetall over the next year, partly due to German spending, but also joint ventures in the US. And they actually predict another 30% upside for this stock despite that rally. We can see that stock up 700% on a 3-year basis there. So JPM positive. Also, Jefferies out with a note. Keep an eye on that one today. Then Air France doing a deal to potentially increase their stake in SAS. This is a Scandinavian airline. It would bring their stake up to around 60%. So here's the makeup on the screen here. We can see actually the Danish government would hold around 26%, but Air France would become the largest holder. And Air France has actually underperformed over the past few years. So this could potentially be a way for them to actually lift the stock, maybe adding to their market share. So keep an eye on Air France later over in Paris. Then we've got Italian banking on the radar once again. Sondrio gets an increased bid price from BPER. That one is going to be in focus, part of a wave of Italian banking M&A that we've seen over the past few months. Keep an eye on Sondrio in Milan this morning.
Thanks, Joe. Joe Easton, our equities reporter. He'll be back later on to take us through how some of those stocks are moving. Big picture, though, a lot of nervousness in markets. No US trading today. CAC futures in particular down by 0.7%. A focus on trade, perhaps, without our US friends. We'll be back with the market open here in Europe. This is Bloomberg.
Friday morning, good morning. A few things to know this morning, one of which is the Americans are off doing something else. Something to do with independence, I don't know. Ancient history. Let's talk a little bit about what the more recent history looks like and figure out what yesterday's session looked like. Yesterday was really about one thing, and that was the payroll data. And the payroll data was actually all right. And the equity market quite liked that, despite the fact that we're pricing out Fed rate cuts. The market still was fairly favourable. As you can see, we basically went up. The US market closed a little bit early yesterday, so actually I don't think many people were at their desks. Nevertheless, positive reaction. I think we'll get the full reaction when it comes to the Monday trade, Val.
Looks like we are erasing some of those gains you mentioned on that hot payroll print yesterday. We have Eurostoxx 50 futures down nearly 0.6%. That's echoing the latest worries about trade as President Trump claims that maybe the EU is going to get one of those letters. FTSE 100 down 0.3%. DAX futures down 0.4%. Anna, what stocks are on our radar this morning?
Yeah, well, I suppose big picture, that is the risk, as you say, Valerie, that someone in Europe or that Europe gets that kind of letter. Let's have a look, as you say, at some of the individual stocks and those those that could be on the move this morning. Rheinmetall, Joe was talking to us about a note out in Rheinmetall where we've seen a substantial raising of the price target. So that's certainly something we're going to be watching, see how that one responds there. We're also watching consolidation within the aviation space. Air France-KLM initiating the process of raising its stake in SAS to over 60%, in fact. So this long talked about consolidation within the aviation sector, something that increasingly perhaps on the radar. And Alstom winning a €2 billion train order from New York's Metropolitan Transportation Authority. Guy.
New York trains made by the French. I suspect it's not quite so simple as that, but it's a nice story to talk about. OK, here we go. Friday session. You're going to see very light volumes today. As we've mentioned, the Americans are out. They're off doing other things, not watching what is happening in markets, though the president does seem to be signing a few letters today, which I think will be interesting from a market perspective. FTSE 100 doing absolutely nothing. IBEX is down by 0.6%, so a little bit of weakness coming through into the Spanish market this morning. The Stock 600 is down by 0.2%. It has, as Valerie pointed out a little bit earlier on, underperformed, you could argue, even in dollar terms, the US markets over the last few months. I think it's 18% versus 24%, something like that, on the S&P. So maybe you want to widen the lens a bit, take a slightly longer term story and talk about what is happening year to date, because maybe the maths looks a little bit different that way around. As ever, pick your time frame. Anyway, as you can see, sea of red across Europe this morning. We are down, actually. We are unwinding some of the gains yesterday. Some actually not insubstantial losses, less than 1%, but still some fairly decent losses to the downside. The CAC is down by 0.6%. The IBEX is down by 0.5% as well. The DAX is down by 0.4%. The London market down by 0.3%. Valerie, sectors, if you will.
Look, Guy, we've got nearly all sectors in the red so far this morning. The only one that's standing out in the green is telecom. But at the bottom of the basket, tech stocks, basic resources, chemicals. Looking at those single movers, we are seeing some upside in Rheinmetall shares, Anna, up 1.2% on that positive upgrade from JP Morgan. So it does seem like that positivity around European defense stocks is continuing. But the sectors mostly in the red.
Yeah, absolutely, mostly in the red. And you mentioned telecoms, almost as one area in green. Almost in green, but not quite. Food, beverage and tobacco. So it does have a defensive flavour to it, doesn't it? The sort of relatively best performing part of this market. As you say, Vodafone up by 0.6%. To the downside then, it feels growthy things being sold off. Basic resources down by 0.8%. Pretty broad base. That's selling in the mining sector. Technology, consumer products and services also under pressure. And in terms of the market picture, interesting that the CAC commodity is down 0.6%. Yeah. So it's down more than some of the other markets, but not quite as much as futures might have suggested.
So Remi's down fairly sharply. Somebody was just pointing out a headline that suggests that China has just set a tariff on EU brandy imports after a probe that they have been conducting. The duties will be applied from July the 5th, so from tomorrow. But Remi's down 2% on the back of that. LVMH not dropping quite so much. But you are seeing some weakness maybe in the spirit sector this morning.
Part of a wider deterioration in the Europe-China story, and we perhaps should have made more at the top of the programme of the fact that the second day of some of those talks between China and Europe has been called off. That's supposed to take place at the end of, or later on this month, isn't it, Val?
Yeah, maybe China is just becoming wary that these U.S. trade negotiations will move to isolate China in some manner after we saw that Vietnam trade deal have a higher than expected tariff on transshipments. And we know that at least the trade between China and Vietnam has reached a record in the last few months because of those transshipments to get around tariffs.
Absolutely. How does Europe fit into the wider narrative? As you were hinting at maybe earlier on, maybe what we're going to see here is any Europe trade deal, including some really big elements of that. And that's a really big one because the Europeans import a lot of stuff from China, integrated in some of the products that they then make and then ship it on to the United States, kind of where... That's a fairly blurred area in which to operate.
Let's talk about the latest news flow surrounding trade and how that is being received by markets. Remy Oluputam joins us, head of multi-asset growth and income at Schroders. Remy, very nice to have you with us this morning. So let me ask you about the latest trade news line. Seems to be making the markets a little nervous. Certainly we could see that in how futures were trading here for Europe, and now we have a little bit of weakness on these European equity markets. Should we be worrying about something as specific as Europe's going to get a letter from the Trump administration saying this is the tariff you'll pay? Or is it just a sort of broad nervousness around the tariff story?
I think it's a mixture of both. I mean, we've had a wonderful couple of weeks for equity markets where everything has been quite positive. So it is due a little bit of a pause and to remember that we are still in an environment of trade wars. And so that's one of the reasons why investors are having to come back to tariffs. We've got the deadline of the 9th of July. And Europe is at the thick of it because we haven't had any concrete negotiations. And so there is some vulnerability for Europe. It's hard to negotiate with Europe. So it is right for markets to worry.
Yeah.
I think the magnitude of the worry is quite limited.
Quite limited, yes. I was going to ask, because you're positive on stocks broadly, positive on US stocks, positive on European stocks and Japanese and emerging markets, lots of stocks.
Yeah.
So you don't think then, and we were talking about this at the top of the programme, you think maybe the market isn't going to be transfixed by this in the same way it was in April?
It will be noise, it will generate volatility, but I do believe a lot of investors are not in the market as much as they should be. So this could be an opportunity that they've been waiting for.
In terms of where you should you be limiting your exposure to the United States at the moment? US markets look like they're on a tear, fresh record highs. There's been this idea that ex-United States investors are looking elsewhere. Is that the right trade, given what is happening with those American markets? Valerie keeps pointing out to me that they've done very well over the last 3 months, outperformed.
They have done. And there's a lot of nervousness, pessimism around the US.
Yep.
But I think our argument is that all markets should do well. I think for the last 10 years, it has been dominated by the US. It's an opportunity for international markets to catch up. So the divergence in terms of US potential outperformance should be a lot lower. We expect all the markets, all the major markets, Europe, Japan and the US, to do extremely well.
What's the difference there? So the US markets, how much more outperformance am I going to get if I invest outside the United States?
I think from here, from where we are right now, there should be a lot more outperformance. If you just look at the valuation potential, the fact that these markets are still undervalued relative to the US, I think there's a premium of 10+% in terms of outperformance.
And that's going to close to... we're below historic norms in terms of the spread that you would normally... You think we close to historic norms? You go beyond that? Kind of...
Typically, you have to go beyond. So things have to move. I think you never get to equilibrium, you always go beyond equilibrium. So in our opinion, these markets will become overvalued relative to the US. Now, this could take a decade,
right,
but that's coming.
Okay, so you're pitching a more diversified equity portfolio. I'm going to ask Guy's favorite question here, which is, do you currency hedge?
We used to, but not now. Well, it depends what your base currency is. I think the meaningful thing is that we expect the dollar to weaken. And that's part of this trend. So I guess the race for international equities also means moving away from the US, which also means that moving away from the US dollar. So hand in hand with this is a weaker dollar.
Is any fiscal drivers a part of that upside risk for the rest of the world equities? We know that it's not only the US spending money. You have Canada, you have China, Germany as well. I mean, nations across the globe, even Japan, getting closer to fiscal expansion. Is that part of the call for the rest of the world to outperform?
Yes, because the rest of the world need to spend on growth, which is missing, certainly in Europe. And I think that's catching the attention of investors to hunt for value in these areas that have the potential to deliver outsized growth. So absolutely. I think the one critical thing when we talk about fiscal is that the bond market needs to behave. And so that's definitely critical. I think where we have the risk in terms of the bond market is in the US and potentially in the UK, as you know, as we're used to. But in the US, that is a risk. And that's part of, we have had a good behavior from the bond market over the last couple of weeks. And that's one of the reasons why equity markets have had the freedom to recover.
Remy, diving into at least one sector here, I think we've already been mentioning, I think Guy mentioned earlier that China has imposed anti-dumping duties on EU brandy imports, and we were talking about how, you know, there are many ways that the EU-China relationship looks a little bit strained right now. Are there certain sectors, I mean, and we've had sectoral tariffs in some places, not others. They've been threatened but not come. Are there sectors that you stay away from because you think they just their brands make them very exposed to some of these news headlines?
Yes, I mean the luxury goods sector in Europe, which we have a lot of, that's a very it is quite a vulnerable sector right now. Manufacturing remains quite vulnerable, and so we're sticking to more domestic sectors that benefit from what we are seeing in terms of policy, which is spending for growth domestically, which is quite insular. So that's one of the reasons why we like financials in the US for deregulation, in Europe because of growth. I think the manufacturing sector is still a very risky area that we cannot predict the dynamics of trade.
What do you think about the UK market right now?
Tough question. I want to love the UK market.
Okay, why? Why do you want to love it? And by the sounds of things, why don't you love it?
We want to love it because it looks cheap. The UK market looks cheap. Why don't we love it is that we don't have enough to own. I mean, the challenge we have with the UK market is that it feels like every company is leaving the UK, so it's becoming rather concentrated.
Okay.
So it's a tough market, and it's at the mercy of external factors or what's happening with regards to fixed income. So it feels like the UK lacks its own strong trend, unfortunately.
Do you think we're in the situation where the government may force us all to own more UK stocks?
Well, that is possible. That could help. I think if we have another buyer that has no price, that could help the market.
Right.
I think the market is dying from demand.
Right.
Particularly capital flows. I think that could help, and that could bringing in investors could also bring a supply of strong companies.
Great to see you. Thank you very much indeed for joining us this morning. Remy Olo-Patan, Head of Multi-Asset Growth and Income, joining us from Schroders. Call 6 looks like this morning. It's a bit of a kind of non-session today, you could argue, but there are actually some significant stories, and the trade narrative, I think, is writ large across what is happening here. It's interesting to see that LVMH, so second one in on the left, as you can see, is underperforming a little bit. So it's down by 2% now, MC. So you're seeing a significant sector underperformance coming from the luxury space, but more those with focus on what is happening in the spirits sector. But I do wonder whether you could extend this, and this is one of the areas that China may decide that it's going to focus on, because it's an area of potential weakness and vulnerability for Europe, and that is the luxury space. So LVMH is now down by over 2%. But you're seeing weakness across the board. The chip sector is down as well. As you can see, ASML is down pretty hard. You've also got some significant losses in the pharma space as well. So we're giving back ground in a number of different areas. It is red across the screen. Joe's got some other areas that we should be focusing on. What do you got?
So those drink stocks, Guy, as you mentioned there, LVMH exposed to this as well. So that is potentially that weakness, as Guy was explaining, coming through into any stocks exposed to drinks. So Remy Cointreau, really the hardest hit on these headlines around China imposing levies on the drinks because of an anti-dumping probe, specifically on brandy, but kind of giving a broader feeling of a crackdown on goods coming into China in the drink space. So Remy down sharply, Pernod as well, almost 4% on that one, LVMH, as we mentioned, and Campari coming down as well. Diageo was lower, all of them really hit on these fresh headlines. So that is the big breaking news weighing on the sectors today in terms of the drinks and the luxury space. Then we've got Rheinmetall. We mentioned earlier they held this call last night with investors. There's a transcript of this on the Bloomberg terminal, and also we've got notes out from JP Morgan upping their target, and also Jefferies as well had a take. It does look like the orders potentially underestimated, even after this big rally that we've seen in Rheinmetall, and all the defence stocks. Analysts still think the stocks could go higher. JP Morgan thinks the stock has another 30% to run in terms of where the stock is now. They're above 200, well above 200 euros in terms of their price target on that one. Then we've got Alstom, as Guy mentioned earlier, a French company making trains in New York, but it is a €2 billion order. The trains, I believe, are on the Long Island route, and that is where they are upgrading to Alstom, getting that order, and that is boosting that stock very slightly, only up 0.3%, but not a bad move, given it's a pretty negative day today. Then in terms of banking, Sondrio, that one was up around 4% at the open, coming down a little bit now, but they have got that increased bid from BP all of this Italian banking emanates. It's never-ending, more and more stories. We've got the Monte Paschi story as well going on, and this one getting that increased bid, so that is a little boost for that one. Then finally, to finish on two financial morning calls. Firstly, DWS to the downside. This one is cut at Exane because the flows have deteriorated for the former unit of Deutsche Bank, the one that was spun out of Deutsche Bank. It is the asset manager, so they're downgrading that one, falling almost 2%, but going the other way, a bit more positive. CVC Capital in private equity in Amsterdam, upgraded at JP Morgan because of better exit rates in private equity at the moment. That's the positive take on the financials, and that one is a little bit higher in Amsterdam this morning.
Joe, thank you. Joe Easton from our equities team, of course. Coming up on the programme, OPEC, OPEC Plus, in fact, its expanded version, weighs another super-size output hike in August. We will have a preview ahead of the group's meeting this weekend. That's next. This is Bloomberg. Welcome back. This is the opening trade. It is Friday, the 4th of July. Independence Day markets look like this here in Europe. They won't be trading in the United States. Of course, futures are open. US futures point a little lower, down by 0.4%. But this is what we have for cash equities here in Europe. We're down by 0.7% on the CAC 40, and there's a couple of things in play here. There's a drink story, which we'll get to in a moment, and there's that coming out of China, and there's also the broader tariff concerns that emanate from the United States. Let's put that to one side for a moment and think about something on the agenda for this weekend. OPEC Plus has begun discussing another supersized output hike for August ahead of the group's video conference on Sunday. We understand the alliance is considering a further increase of more than 400,000 barrels a day. What does that do to supply? Let's bring in Will Kennedy, Bloomberg's Senior Executive Editor for Energy and Commodities, with us round the desk this Friday. Will, so oil prices once again on the back foot this morning, down 0.5%, moving towards this. There's a meeting this weekend. There's further gatherings, I think, next week. The expectation is we just get more supply, is it?
Yeah, I think that's right. This 411 rise has been flagged now for several weeks, and our reporting suggests that that is still the likely plan. A month ago, they didn't do as much as the market expected because Russia wasn't very keen, but we had a story last week that suggests that Russia as well is OK with this plan. So I think the market's expectation is it will happen. If we're looking for less likely surprising scenarios, occasionally there are mutterings about the Saudis going even faster, rip the sticking plaster off. But we don't think that that's necessarily going to happen this weekend, and that 411 increase will happen. But it's been well flagged, so I think it's probably largely priced in.
So this will be their fourth meeting in a row if they go ahead with this? It seems a lot of momentum behind this. What would give OPEC maybe a reason to pause in the further months ahead? I
mean, I think they would have to see a real shock to demand that bought prices substantially lower from where they are. I think the Saudi calculation that in this sort of $60, $65 range, at the rate they're increasing production, they can probably make that ratio, that product of supply and price work for them. But if we were in the low 50s, I don't think it might work as well. So in that, there might be conversations about not going quite so fast. But I think from their perspective, everything that we can see suggests that they're comfortable with the strategy of progressively putting this oil back into the market quite quickly, accepting a price in the 60s, with, in their view, some feeling that the market is going to get tighter over the next few years, and that this is a time for them to grab market share away from the US.
Is that the objective, market share?
I think that's definitely part of the thinking, is that obviously they'd hold their production down quite aggressively for a long time.
Yeah.
US production was rising. They were getting frustrated with some countries who were overproducing their quota, so they felt they're doing all the work for very little reward. They weren't getting the prices that they want, so I think they've had to move to a different strategy and change that. How much you're producing.
Is there a Trump in here as well, in as much as you want to keep the president happy with lower oil prices?
Yeah, I mean,
at the same time, you're trying to cripple the US oil industry.
I think when we have these conversations, there's sometimes a tendency to look for one motivation, and I think there are several things going on, and the political background is certainly one of them. Are they doing this because of Trump alone? No. Is it useful to be doing it at a time when Trump, keeps saying that low oil prices are a huge priority for them? Yes.
Is this a sledgehammer? Just before I let you go, is this a sledgehammer or are they fine-tuning this market? This feels like this is to Val's point, there's a lot of oil coming onto the market very quickly.
Yeah, but if we look at... There is, but I think it's been quite well flagged. I think people now understand the change in strategy and what's happening. And if we actually look at prices... We had the flare-up during the conflict in the Middle East over recent weeks, but this sort of 65 range is fairly steady.
Okay.
And there are signs, especially in the US, that the market is reasonably tight. So,
Well, great stuff. Thank you very much indeed. Bloomberg's Senior Executive Editor for Energy and Commodities, Will Kennedy. Not sure how I make this pivot, but we're going to do it anyway.
We're getting the popcorn.
Popcorn,
Go ahead.
Culture, pop, everything. Let's talk. So this weekend in Cardiff, Oasis back. Okay, 90s band. I remember it well. I am that old, despite popular opinion that I'm not. That we are going to see. Are they going to be noisier than the rugby fans? Is my key question. Anyway, fashion brands such as Burberry, Adidas, and Levi's are partnering with the band, hoping that the wave of 90s Britpop nostalgia will generate high sales in North America. Joining us now is Bloomberg's opinion columnist, Andrea Felsen. I want to talk about what's happening in the trade story as well. But let's talk about... I remember when this era was in, right?
Me too.
And you had... and Burberry actually had an issue at that point.
They did.
With this kind of culture. At that point, there was a worry that actually football terraces were being populated by people in Burberry caps and jackets but now they're embracing it.
There were sort of two eras. There was the initial era, I'd say, in the late 90s when Burberry had a resurgence and was very cool. And then in the sort of early noughties, it just got too exposed. So Burberry obviously going to the first era when it was very cool. Cool people were wearing the check and it was a thing to have. I think the key difference now is I think a lot of the people they're trying to target probably don't remember the kind of overexposed era.
Yeah.
And it feels really fresh, you know.
We won't go into why they don't remember it, but that's a whole different question.
Yeah, because they weren't born then.
Okay,
Gen Z, they just weren't born. You know, when Liam Gallagher wore that shirt on the video, they weren't born. So, you know, Burberry feels really strong. Burberry's done a great job embracing this look for the marketing. The marketing's been really great, and I think it is building a buzz about the brand. I think if they hadn't done this, it would have been a real omission. This was a golden opportunity for Burberry to really embrace this. Now, what I'll be looking for now is, do they dress the brand? I mean, Liam was wearing his own Burberry parka in some of the promotions. Do they dress the brand? Do they take it even further? What the band do Burberry, like, does he come out and wear the shirt for on the wall?
We will see how far it goes. Speaking of someone who also does remember the 90s. I picked up on something in your piece, though, Andrea, which was really interesting. The sort of marketing potential behind a Oasis comeback tour is quite incredible because it crosses both genders in the way that some of the other 90s nostalgia doesn't.
Exactly. I think this audience is going to be very mixed. I think it's going to be very mixed sort of gender-wise. I think it's going to be very mixed age-wise.
We can return to the ladette. I don't know.
Well,
it is ready for that.
Ladette has now become blokecore. It's got a new name, okay? And we've had all this TikTok aesthetics. But blokecore is one of the only ones that's hung around.
Genuinely new information.
Yeah, and now it's morphed into what's known as bloquette. And bloquette is where you wear a football shirt with like a lace skirt, Miu Miu sneakers. And the thing that sums up bloquette more than anything else is the sneakerina. And that is a cross between a sneaker and a ballet shirt. So, you know... This is why it ticks all the boxes, because you're catering to men. The menswear market's a bit of an opportunity. Men are discovering clothes a bit more.
They've discovered football shirts, let me assure you.
Yeah, but they are into fashion a bit more. Big opportunity. But you've also got this aesthetic, this blokecore aesthetic. So, for brands, it kind of ticks all the boxes. And I think there was this incredible statistic from Depop that, it's really hot, but searches on Depop for parkas are up 1,850%.
Right.
I hope I've got the
for
figure
the uninitiated,
right.
that's because they used to wear these.
Yeah,
the
exactly.
weather is wrong for this.
Exactly,
though,
but
now,
people
Andrea.
are loving it, and bucket hats, and, you know, it's all this kind of aesthetic.
Really hope my children aren't watching.
So brands, you know, if brands can get it right, I think it's a good opportunity. Let's also not forget the weather. The weather's been very helpful to retailers, apart from obviously not good for selling parkas. But, you know, the weather's been really helpful. Everybody reaches for, you know, sandals.
This has been so interesting. I'm so sorry that Val didn't get to join in.
It's totally over my head. British 90s nostalgia, way over my head.
We'll wallow in it for a moment.
The music was good as well. Let's just point that out.
Andrea, thank you so much. Thank you for joining us. Bloomberg opinion columnist Andrea Felstead. I always learn so much.
Anna's actually taking notes.
I am. I'm rewatching this. I'll be Googling later. Right, coming up on the programme, US national security and trade talks collide. We'll get back to much more serious matters. Former Deputy Commerce Secretary Bruce Andrews will be joining us from Aix-en-Provence. That's coming up shortly. This is Bloomberg.
We're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs.
President of the United States, Donald Trump, speaking at Joint Base Andrews last night, talking about the tariff narrative that we are going to be working forward with over this weekend into the beginning of next week. There are letters going out today. He's going to sign them later. Then we're going to move on and get more going out over the weekend as well into next week. Obviously, we're approaching the 8th, 9th. That's the big deadline that everybody is watching out for. What is interesting around all of this is that the US has actually lifted some curbs on technology exports to China over the last couple of days. Overnight, we learned that jet engine parts and chip design software is going to be permissible again. GE has apparently been notified that it can start selling kit back into China. So what is the objective here? Both countries have reached a trade framework. They did so last month. This followed talks in London, which also saw China agree to resume shipments of rare earths. Export controls, historically treated as a kind of non-negotiable national security area, but everything's getting folded into the same bucket at the moment. Let's talk about where this goes, therefore, from here. Bruce Andrews, non-resident senior advisor at the Centre for Strategic and International Studies. He was President Obama's Deputy Secretary of Commerce and later Intel's Chief Government Affairs Officer. Good morning, Bruce. We're all trying to understand and get a sense of direction of where the Trump administration is taking trade and national security and where these two things overlap. We thought coming into the Trump administration that national security, the strategic objective would be to combat China. Yet we're all wondering kind of where we are with that. What is your current sense of play as to where we are? Is national security the objective for the Trump administration or just simply getting trade deals done?
So I would say there are actually two objectives. I think first is, trade is obviously one of the key pillars of President Trump's agenda and something he's very focused on. The U.S.-China trade relationship is the one that the U.S. government is most focused on, but obviously President Trump is attempting to reach deals with a wide variety of countries as well. So not just China, but every other country around the world at the same time. But national security is also a priority, and it's something that the U.S. government has always made a key priority, and it's something, though, that's pursued generally on a separate track. As you pointed out, they are starting to overlap more.
Yeah. Exactly, and therefore I wonder, as we get into that overlap, which is the preeminent priority? Which one supersedes the other? Is it possible to think about one superseding the other?
Sure. I wouldn't look at them as superseding the other. I think there are 2 points that I would make. One is the administration is very complicated, right? Because you've got a variety of different players. You've got players whose biggest focus is national security, and then you've got players whose biggest focus is trade. I mean, I think ultimately, if you look at President Trump, I think his bigger focus is actually trade. The national security piece of this is more done by the national security team, the Secretary of Commerce, Howard Lutnick, and then the other agencies that are involved in export controls. But what I think we've seen here is a bleeding over of the two issues, particularly because the Chinese, since 2017, the Chinese have been preparing for a potential future trade war or negotiations with the United States. And so what the Chinese have done is they've started using export controls as a way to bring counterpressure to the United States.
Bruce, so you just mentioned there that maybe rebalancing trade is more of a priority than national security. I know you were an advisor for Intel back in the day. How would you advise technology companies, American technology companies, to handle, frankly, the volatility of Donald Trump's trade strategy?
Look, as you point out, or as your question implies, certainty is the most important thing for companies. And obviously, manufacturers, particularly companies that manufacture in the United States, need certainty as they make investments to understand what their costs are going to be and will they be internationally competitive to be able to export. As we just saw, exports went down, partially due to the tariffs because of the input costs. So if I was advising one of these companies now, I would say two things. One is be very clear with the White House and with President Trump about what the priorities are, what it is it's going to take to help make U.S. companies successful. And two is there's always a balance between national security. National security is remarkably important to the United States, and every country has to recognize that. But there's also a balance that takes place in making sure that U.S. companies particularly can continue to be leaders in the technology field. And if you put export controls too tight, those can sometimes reduce the ability to have companies be successful. For example, you've seen Jensen Huang, the CEO of NVIDIA, out talking about the potential negative impacts of export controls. So, for companies, the most important thing is to be in a dialogue with the administration, explaining to them what the impacts of the various actions that they're taking. And I do think Secretary Lutnick and the Trump team, are doing outreach to the business community, trying to understand what their priorities and concerns are.
What do you see as these big tech companies' current priorities in these maybe frank negotiations they have with the Trump administration?
Well, so I think every company is different depending on what their business model is, right? For companies that manufacture in the United States, it's very different from companies that manufacture outside the United States, for example. Or if you're a digital platform, you have a very different set of interests than if you're a big hardware tech company, or even other manufacturers who are connected to the tech world. And so I think that's part of the challenge, is that the White House has to balance all of the various interests, particularly in the areas which the United States has been the leader, and how do they have to make the calculation of how do we make sure American companies continue to be leading around the world. And I think that's one of the big balances you're seeing. And as I mentioned, there are different actors within the White House and the administration who prioritize those issues in different ways. And I do think, for example, we saw on the AI diffusion rule, that President Trump recognized the concerns that the tech industry, and particularly NVIDIA, had raised. And so I think, you'll continue to see on each issue a different calculus. But I think for the companies, they need to just continue to be engaging the president and the administration and explaining how these things affect them and what it's going to take to help them to be the most globally competitive.
Bruce, can I ask you from a European perspective, as you're here in Europe with us right now, how you would advise European businesses as they're thinking about a tariff that might be imposed on them by the US administration? Perhaps a deal could still be done. Perhaps a tariff is just imposed by President Trump on Europe. You mentioned earlier that certainty is the most important thing. So would you be advising that actually you should just accept the imposed deal and just try and move on? Don't extend this. Don't retaliate like China did.
No, I mean, look, I think Europe is a Rubik's Cube of interests, right? As I've been talking to a lot of my European friends lately, and we had a great discussion here at X last night where I had the, French foreign minister on the panel that I did. And, the challenge with Europe is you have so many different interests and so many different kind of companies and how they're impacted by this, that I think it is challenging for the Commission to lead these negotiations. Each country has its priorities, and the Commission has to balance them. So to your point, if I was if I was working with a European company right now, the advice that I would give them is to really focus on what are the impacts and how does it affect your ability to do business in the United States, and also explaining that to the U.S. government. I do think that European companies play a very important role in the United States and as part of the U.S. economy. And so I think having an understanding and being able to explain both the benefits that European companies bring to the United States, but also how some of these policies can impact them. I'll give you an example, the BMW factory in South Carolina, where BMW exports SUVs from South Carolina around the world. These tariffs could make BMW much less globally competitive in its ability for that factory in South Carolina, to export outside the United States. And those are the types of things, those are the types of complexities that I think explaining to the U.S. government and having them understand not just how it impacts the American companies, but also impacts American jobs.
Bruce, can I ask you a question about the style of the current U.S. administration? You served under a different one with a very different style. Perhaps you're hearing European views on that in your travels. There seem to be different views out there. Some would say President Trump is taking really bold moves. He's prepared to take risks. And they might argue that former U.S. administrations maybe were too worried, too preoccupied about what might be lost to take bold moves, to take bold actions. Do you think any of that rings true?
No, look, I think President Trump definitely is willing to take bold actions and to see what happens. I think some previous administrations, when they did the analysis, often felt that the negative impacts of some of the actions outweighed taking these actions. I think President Trump has a view, though, of two things. One is trade is one of the key pillars, particularly trade with China, that he was elected on, and it is a big issue to Americans, and there's a lot of concern in the United States about it. But also, President Trump is a big believer in tariffs, and I think most mainstream economists would tell you that that tariffs are risky and can create lots of other side issues, and I think President Trump is doing something because you use the word bold, but an experiment that we'll see what the impact is. And I think that I think we're going to learn over the course of time, as these negotiations take place, what can be done, and whether it's a zero sum, so that the U.S. wins and other countries don't do as well, or if there's an ability to find a win-win, that an agreement can be reached, that President Trump can achieve some of his goals, but while also the trading partners are also able to find benefits to the agreements as well. And I think that's where, as I've watched the negotiations with the EU and Japan and Korea, I think that's the challenge that we're finding. Because every trading partner has its own political set of interests, right? Japan is interesting right now because the LDP is about to go into an upper house election where they're being careful about farmers. India, the farmers are priority, and Europe, the car makers and the agriculture. And, so every country has its own competing political priorities as well. And the question is, can those be balanced in an agreement that everybody wins out of and everybody feels like they're getting something from that agreement?
Bruce, thank you very much. Thank you for your time. Bruce Andrews from the Centre for Strategic and International Studies, bringing us the mood there in Aix-en-Provence at that forum that's taking place, and all the sound effects from it as well. Let us just check on one of our developing stories this morning. Drinks makers squarely in focus for us. European equity markets are trading weaker, and we are seeing some negativity around some of the drinks makers. Now, there's quite a lot of nuance in this story. China imposing anti-dumping duties on European brandy for 5 years, but there are ways you can get exemptions from this, and which of the 34 EU brandy makers will be eligible for tariff exemptions will be something that everyone is diving into now.
So there's been a huge bounce here.
Yeah.
Remy's now positive after being down, circa 7% not that long ago. China is saying that there'll be no duty on 34 brands companies if they fulfil a price pledge.
Yeah.
What does that mean? Don't know details of it, but the market's certainly seeing this as there's a window here to get around this, and the market's reacting really quite strongly. Some real volatility in these stocks. Up next, we're going to talk about what is happening over in the United States when it comes to the labour market. Hot job print yesterday, the US economy, tariffs. We're going to talk about it all. Sri Kochagovadan from Aberdeen is going to be joining us next. This is Bloomberg.
Welcome back. This is the opening trade. Now, a better than expected US jobs report has eased the pressure on the Fed to cut rates. Perhaps the political pressure might continue. Sri Kochagovadan joins us, senior research economist at Aberdeen. So, Sri, you can see on the board there lots of ways that the data beat expectations, whether it was job creation, unemployment rate, and other things. And stocks went higher, and even though the market was pricing out Fed cuts, was seen as pretty good news for markets. Was there anything in any fly in the ointment, any crack that you saw for the labour market?
Overall, it was incredibly strong. I think going forward, there was stronger wage growth there. Obviously, that's going to be helping the Fed stay on hold. But going forward, I think, overall, there are some initial signs of easing, not necessarily slowing of the labour market, not necessarily in the jobs report, but in other things like the JOLTS report or unemployment claims. But overall, this is a very strong report that suggests that there's no reason for the Fed to move just yet. So again, the political pressure will be there, but the actual hard data is not really justifying a cut anytime soon.
Yeah, I mean, we failed to really see a big impact of tariffs yet in the hard data, and I think it's raising questions of whether we're ever going to see a big impact in the labor market on tariffs. What's your view on that? Is it just something that might hit the U.S. economy in the third quarter, or are we going to accelerate from here?
I think from here it's very difficult to accelerate because this tariff impact is going to be a tax on consumers. So that's going to start to filter through into the consumption data as we move into the second half of the year. I think right now there's still a bit of a fog in terms of the data. We saw sentiment collapsing, but the hard data, it takes time to really filter through. That tariff impact, obviously there's the uncertainty and there's a bit of a hiring freeze. We are seeing some of that in the initial, private employment was a bit weaker. It's slowing. So there is a hiring freeze there, and there is that uncertainty in terms of investment going forward. So all of that will start to filter through in the second half of the year, but we're not seeing the evidence of it yet. So again, there's a fog that the Fed can't really move just yet. So.
Are you surprised it's taking this long?
No. I think what we've seen is the initial announcements, and then there was a pullback. And now today, again, we're going to see tariffs going up again briefly, potentially. And then perhaps that will settle down. So we had this sort of average weighted tariff, which I think consensus is around 10 to 15% is where they're expected to settle. But with all this continuous noise of, OK, actually, we're going to have unilateral tariffs announced, there is a continued uncertainty. So it's very difficult to make business decisions in this environment. So it's not a situation where you can be cutting labour. You want to be holding, you want to be retaining, but not necessarily hiring new workers. So that's the environment that we're in. But again, it's not going to stay stable like this for very long.
So that's why you might hoard labour. What about the inflation side? Val and I were talking earlier on about, we get inflation data soon. Maybe will it again be too soon to see the inflation impact of tariffs? Given that a lot of the stock, depending what it is, how perishable, a lot of stock is bought ahead of time and then held, especially post-COVID. A lot of supply chains had to be made more robust, a little bit less just in time. So does that delay how long it takes for this pass-through?
Yes, it's quite interesting in terms of the tariffs. There was the inventory build beforehand, and then there was a pause. There was a bit of an inventory build again. So there's there's some supply there that is preventing this pass-through into inflation, just for now. But also the customs data is not really showing a big increase in tariffs. So that's a little bit confusing as well. Like what's actually happened with the bureaucracy? How is this being implemented? It's not very easy for this to be implemented, given the constant changes. So, again, I think this is going to start filtering through over the course of the next few months. But, we can't say this is it. It's inflation-free. The indications from surveys are that the price pressures will start to filter through in time. So that we're starting to see in the details of PMIs. And the PMI breakdown has been signalling a stagflationary outlook, but we're not seeing it in the hard data just yet.
In terms of... We're talking about growth reaccelerating at the moment. And you're saying you see it quite hard for growth to reaccelerate. In aggregate, if you take together what is happening with tariffs, the big beautiful bill, what is happening with a consumer that still looks like it's fairly robust, are we going to see a more volatile economic second half or a less volatile second?
I think what we're going to see is a real mix of data. I think in terms of the bill, the reconciliation bill, I think that will take time to filter through. Those tax cuts will not be implemented immediately. In terms of tariff revenue, that will take time to be, really filtered through into the budget. How much of that will be spent? So there are lots of question marks there. So again, in terms of the data itself, we'll probably see a mixed set of signals that will eventually filter through over time, with some of the activity data perhaps different measures of activity for manufacturing or for consumer spending. That will start to filter through in time. As these tariffs filter through, maybe the consumer spending data will see more clarity in Q4 rather than in Q3. And so we'll have
the market will look at the bit that it wants to look at.
Yes.
Decide that
rose-tinted glasses.
Everything's great. Sri, nice to see you. Thank you very much indeed for coming to see us. Sri Kojagovidan, Senior Research Economist, joining us from Aberdeen. Let's talk about what is coming next. The United States is closed today. US markets are closed. It is the 4th of July. There's a few other things going on, though, that we should pay attention to. We'll come on to the weekend in just a moment. Andrew Bailey's going to be speaking over the weekend. We've also got a BRICS meeting, got an OPEC meeting coming up. There's a few things that are happening, but it feels like we're edging. I think this is already there, but we're edging towards a weekend, of which there are many things happening.
There are many things happening, many of a sporting nature, and we'll come to the weekend in a moment. And cultural, plenty of that too. But let's linger on sport because we have a nice Bloomberg angle on a golfing story, which we couldn't resist getting into the show because Guy is such a big fan of golf. Golf in Scotland has a slightly different dynamic to the one in the United States and in England, we understand from our colleagues reporting. Away from the sports royalty and the glitz of venues such as US President Donald Trump's 2 resorts, it's actually seen as a bit more of an accessible sport in Scotland. It is the home of golf, though, apparently, has little to smile about when it comes to President Trump's attention on the subject. Let's bring in Bloomberg's James Ludden, who's in Edinburgh. James, good morning to you. So Trump's Scottish golf assets seem to be encouraging wealthy American visitors to Scotland. That all sounds like a good thing for golf clubs. So what's the problem?
Well, it's a good thing for golf clubs if you are a Trump course or one of the big established courses like Carnoustie or Royal Dornoch. You can afford to charge hundreds and hundreds of pounds for a round. If you want to turn up to Trump Turnberry, you could be forking out like £1,000 just for that. For smaller clubs, you don't have that luxury of charging so much money. And at the same time, you've got costs are going up, whether that be the cost of fertiliser, the cost of payroll, running a bar. You've suddenly got to pay a couple of extra £1,000 for payroll, the cost of machinery to keep your greens in decent nick. All the costs are going up, and yet the revenue is slightly capped in the sense that I've been living here long enough to know that parting a Scots person of £100 is no small ask. So if you want to extrapolate that to golf, then you've are you going to charge £100 for the privilege of knocking a small white ball around Scottish turf? Well, not everyone's going to go for that, especially if you're a local guy or girl.
All right, so it seems like the trickle down isn't working at all. The clubs, the bigger clubs that are attracting the Americans are doing well. But what are the smaller clubs doing to counter that trend?
Yeah, you have to reinvent themselves a little bit. There's a course just over my left shoulder there called Prestonfield, which is in the lee of Arthur's Seat, which is a volcano, an extinct volcano, I should add. And they're doing things like, it's not just about the golf. You turn up there, you want to play golf, it's 60 quid, fine. But if you don't play golf, it's a 10-minute cab ride, and they're laying on things like a Scottish evening of dinner followed by, of all things, bagpipe lessons. And they have a lot of people coming in doing that. So you're kind of broadening your revenue streams to other aspects. Yeah. There's a course way up north called Tain, which they, like many clubs up there, they've kind of broadened who is allowed and who is not allowed in the clubhouse. So previously, if you wanted to have a drink or a bite to eat, you had to be a member or a member's guest. But now they've broadened out to the community, and that's, again, means more revenue coming in.
I also have to say, speaking from experience, There seem to be a lot of teenagers playing golf now, which is really annoying. Trying to get tea times at the moment with school holidays on. Anyway, it's a good thing for the game. James, great stuff. Thank you very much indeed. So the weekend is upon us.
Yes, so much sport.
Lots of sport. But there are cultural things. Oasis are playing in Cardiff.
Yes.
Are they going to be noisier than the rugby fans?
Absolutely. Other music events also available. Wimbledon continues.
Yep.
I watched far too much of that yesterday.
And the Tour de France kicks off.
And the Tour de France. And it is the 4th of July, Valerie, so congratulations.
Thank you.
That is it for the opening trade. The Pulse is up next. This is Bloomberg.